All right, a little bit more of an introduction to the MACRS system. This is just to get you kind of up to speed. You're like, at this point, you're still like, hey, what the heck is he talking about? What is MACRS? Well, that is the Modified Accelerated Cost Recovery System. Oh my gosh, that is quite the mouthful. It's the primary method of depreciation for federal income tax purposes in the United States. It was introduced in 1986, and not that any of these dates are ever important. I just think it's interesting. Little tax history, don't you agree with me? There's nothing more important than tax history. This sought to simplify the tax code and replace the prior depreciation system, which was just the accelerated cost recovery system. So just that acres. We go from acres to MACRS, and MACRS is designed to allow businesses to recover the cost of tangible property over a specified recovery period through annual depreciation deductions. You think straight line's easier? You're right, 100%. Straight line's a lot easier. This is just the way the IRS wants to do it. I mean, they have all their calculations and things baked in. The system accelerates depreciation by allowing larger deductions in the early years of an asset's life and smaller deductions in later years compared to the straight line depreciation method. Under MACRS, assets are classified into different property classes based on their recovery periods, which determine the number of years over which the cost of the assets can be recovered. And the most common recovery periods are those ones which we did see. You want to know, again, more so the 5 and 7 years, along with separate categories for residential and non-residential real property. I would memorize these as well. So the life for residential property, 27.5 years, and non-residential real property is 39 years, respectively. Now, to calculate MACRS depreciation, taxpayers use a set of predetermined tables provided by the IRS and provided by the AICPA for exhibits on the exam when you see SIMs, which are based on the asset's property class and the selected depreciation method, usually the 200 or 150% declining balance method, switching to the straight line method when it provides a greater deduction. Now, note that when you use MACRS depreciation, we will ignore that salvage value. All right, now we're introducing the concepts of the half-year convention and mid-quarter convention. Don't you worry, we're going to have examples. These are introductions. For me, I very much learn through examples, through visualizations, and numbers. And that is, statistically speaking, the way a lot of you will learn as well. So I will have examples. So if you are feeling like this is intimidating with all the words, don't you worry, we will break it all out for you. Now, the half-year and mid-quarter conventions are methods used by the MACRS system to calculate the depreciation of assets for tax purposes. These conventions help standardize the way depreciation is calculated, ensuring a more consistent and fair approach across all of our businesses here. And the gist of this, what's the point? Like, why are we making this more complicated, Nick? And to which I say, well, go ask the IRS. This is really just more so, okay, everything would be fair and simple if you just placed it into service on January 1st and had a nice clean year. But what happens if you place your assets into service halfway through the year or a quarter into the year? That's what we're dealing with here. The half-year convention and mid-quarter convention, these are dealing with treatment of depreciation kind of in a more granular level when you're dealing with putting these assets into service and other, the majority of your assets or a minority of your assets into service in varying times during the year. Just first off, note that the half-year convention, that's for personal property only, and the mid-quarter convention is for both personal and real property. I would memorize that. Starting off the half-year convention, this assumes that all assets are placed in service in the middle of the year, regardless of when they were actually placed in service. This convention simplifies the depreciation calculation and ensures that each asset is depreciated for half a year in the year of acquisition and half a year in the final year of its recovery period. The rationale behind this method is to prevent businesses from placing assets into service late in the tax year to maximize depreciation deductions in the first year. This helps to average the depreciation across the tax year, helping to create a more equitable treatment of depreciation for all taxpayers. Now, the mid-quarter convention, and I know it's difficult because we don't see examples yet, but for sure I am going to give you plenty of those. The mid-quarter convention is used when more than 40%, and memorize that 40%, when more than 40% of the total depreciable basis of properties placed in service during the last 3 months of the tax year. So memorize that. This is something when I was studying, I was not as familiar on, and it hurt me a little bit. I obviously got through, but take the time now, memorize this. Keep in mind that the 40% only considers assets placed into service that year. For example, finally getting to what I love, my examples here. For example, if in February of year 3, a company placed into service 2 pieces of equipment which have a value of $50,000 each, the 2 assets with a total value of $100,000 would use the half-year convention for the rest of their lives. Because, well, we saw that 100% was placed into service in the beginning of the year. Now, if in October of year 4, the company places into service an asset worth $40,000 and no others, that $40,000, you might get tricked and think, well, that's $40,000 out of the total of $140,000. Nope. It is individually each year. So in the next year, in year 4, we have 100% is placed into service. We see in October, in the last quarter, that $40,000 is 100% of assets placed into service in year 4. And as such, the $40,000 asset would use the mid-quarter convention for the rest of its life. Now, the 40% applies to each year separately, as I pointed out there. That's something that I've seen people get tripped up on in Sims when we're running through them together, so do not let that be you. In this convention, assets are assumed to be placed into service in the middle of the respective quarter in which they're actually placed in service. Again, kind of overall the rationale for all these conventions is to further refine the depreciation calculation and provide a more accurate representation of the actual usage of the assets. You could just memorize it as a step-by-step mathematical process. That's fine. Just, again, why are we doing this? Well, the IRS believes this is one of the most equitable way to do things. And God knows the IRS is, they are the holy word in the land of this law, right? This convention discourages businesses from manipulating depreciation deductions by placing a significant portion of their assets in service late in the tax year. All right, and moving along. Next slide, focusing more so on the second paragraph. First one's kind of a little bit of a repetition. It's essential to note that once a taxpayer starts using a particular convention for an asset, they must continue using that convention for the entire recovery period. All right, I mean, it's kind of a repeat of what we saw, but again, want to beat that point down for you. The choice between the half-year convention and the mid-quarter convention depends on the timing of asset purchases and the proportion of assets placed in service during the last 3 months of the tax year. Pointing out these, make sure you memorize them, you'll be good to go. All right, taking a look at our schedules, these are what you'll see on the exam with exhibits. You don't have to memorize this. You'll see the same numbers. It's not like these numbers are jumbled up or anything. It's kind of like looking at the present value tables, dealing with other exams. You see here in the earlier years, you can take higher proportions of depreciation, 33, 44. Now it goes up, down, sideways, all around. That's just their calculations. You don't question it. Don't think about it too much. But generally, you see it's a certain amount. It goes up a little bit, then drops significantly past that first number. This is a depreciation schedule. This is what you'll see for the MACRS half-year convention. Step 1 is to identify what is the class. Is it a 5-year asset, 7-year asset? Then what convention are we using? And as such, you'll open up the exhibit. Again, on the exam, you'll have multiple exhibits, and you'll have to determine which table should you use. Here's the mid-quarter, and also this would be if it's placed into service first quarter. We get the second quarter, third, fourth, all that good stuff. The fifth quarter, oh wait, that's not how that works. Second quarter, just kind of here for your viewing pleasure. Or I could just start playing a movie. Maybe you'd like that better. Nice comedy would be good. Just taking a look. General familiarity. I don't want you to get in the exam or even start practicing questions and thinking, oh my gosh, what's going on? Whoa, this one's a little bit crazy here, am I right? Now, just keep in mind here, this is simplified because this goes on for quite a bit. We see here years 2 to 9 are crammed in here. We are going to have that same amount for that all of those years. We see the month the property was placed in service. We've got going throughout the years. This is for our residential real estate. Now we're looking at our 39-year commercial real estate table for MACRS. Again, this is good general familiarity. You'll have these to practice with throughout the exam. Yes, you'll likely see these in sim format. It would be kind of aggressive to see this as a multiple choice question. We've got our wonderful example here. We're going to see our half-year convention, mid-quarter convention, everything in between. Well, there's nothing in between, so it's just going to be these. We're going to assume that equipment placed in service in both years has a 5-year recovery period under MACRS. That we're skipping that step, but normally you would say, oh, you have a car. What is the tier that this falls into? Is it 5 years, 7 years? So you'd have to determine that. First off, what happens? Well, let's read this kind of like a story. First off, we have year 3. Now, in February, 2 pieces of equipment with a value of $50,000 each, total value of $100,000. These are placed in service. They're going to use the half-year convention for the rest of their lives. Following those rules, remembering when we're using each convention, the half-year convention and the mid-quarter convention. Then we've got, in October, 1 piece of equipment with a value of $40,000 is placed in service. Since it represents 100% of the assets placed into service in year 4, and it was in our last quarter, that is going to use the mid-quarter convention for the rest of its life. We see how that works. We saw the examples prior. Now, these are just snippets from those tables. I didn't want to obviously bring the whole table into this. That would be a little aggressive. So here we just see year 1, 20%, 32%. And here's how we do our calculations. So we would take the value of those assets and do a nice little multiplication, $100,000, $100,000. And we're running through that here. This is for our mid-quarter convention, our 40,000. 40,000 times 5%, just pulling that from the table. We look at the table. see those amounts there. In this example, we can see that the assets placed in service in year 3 use the half-year convention for their entire depreciable life, while the asset placed in service in year 4 uses the mid-quarter convention for its entire depreciable life. All right, more examples. It's the best way to learn. I love it. Tech Innovators, a calendar year corporation, purchased and placed into service office equipment during October year 2. No other equipment was placed into service during year 2. Now, under the general MACRS depreciation system, we must use the mid quarter convention here. When a taxpayer places 40% or more of its property, other than certain qualifying real property, into service in the last quarter of the taxable year, the corporation must use the mid quarter convention for MACRS depreciation purposes. I'm just beating this to death because this is really the main thing with these questions you could get tripped up on or get wrong in the exam. So you are getting the repetition here to make sure you know it, practice it yourself, study it, memorize. With this method, the acquisitions are segregated by quarter and treated as if placed in service in the middle of each respective quarter. That's why we saw the Q1 table, Q2, getting you familiar with the exhibits that you'll see on the exam. All right, coming along here. Assume you purchased an asset for $10,000. It's got a 5-year recovery period under MACRS. Under the half-year convention, the asset is assumed to be placed into service in the middle of the year, and the depreciation rates for a 5-year recovery period are as follows. You see these amounts, you might be starting to get a little familiar with the percentages as well. Again, just taking another look at how this works mathematically. Right? We take that $10,000 and just run it through those percentages. But we also see that in the first year, since it's treated as if it was placed into service in the middle of the year, we're going to have to do times 0.5 or divide by 2, just keeping a note there. So this is a 5-year life, but we are doing half of a year in year 1, half of a year in year 6. So good examples for mathematical numerical examples. Note that the total annual depreciation amounts do not equal the original basis of $10,000. It just occurs when using the half and mid-quarter conventions. I noticed this a while ago when went back when I was studying, and something I knew I'd have to address here. And don't worry about that too much. Kind of the combination of rounding errors as well as this is just how the tables work. But if that was something you noticed as well, then you are observant. All right, same as the prior slide. Assume you purchased an asset for $10,000. It has a 5-year recovery period under MACRS. Now assume the asset was placed into service in the last quarter of the tax year, and more than 40% of the total depreciable basis of the property was placed in service during this quarter. So if it's just one asset and it was in the last quarter, then basically because of that, we would use the mid-quarter convention. In this case, as we said, we would use that mid-quarter convention. The depreciation rates are as follows. And then we pull up the proper table from the exhibit, and here's how we would calculate the depreciation. Again, just running through this, it may be boring, and hey, I don't know how it could be boring. You're going through questions with me. But these are great examples, really, of what you'd see of full-on sims on the exam, right? So that $10,000 times 5%, then continuing on. And again, reference the tables. If you want to pull them up in our resources, feel free so you can have them in front of you as you're checking these out for examples. Now, as illustrated here, the half-year and mid-quarter conventions affect the depreciation calculations, ensuring a consistent and fair approach. That's just something, whether it's bankruptcy or cost recovery or anything, that's the rationale. We're trying to make everything fair and equitable. Is that how it ends up being? Oh, not at all. But hey, that's life. Just trying to get through it, survive it. Moving on to the next. All right, some miscellaneous points here on MACRS depreciation. If an asset is disposed of before the last year of its applicable recovery period, only half of the depreciation for the year should be taken. Now, disposed, that means either just thrown out, it was destroyed, or you sold it. So in any capacity, it was disposed of. Now, the quarter-year convention method must be used for all personal property if more than 40% of the total personal property was placed in service during the last quarter of the tax year. This convention also applies to the property purchased in the last quarter. The quarter-year convention does not apply to real property. These are just some points we've seen as well. Want to make sure that you have those memorized. The MACRS depreciation tables are adjusted based on the quarter when the asset was placed in service. The percentage values in these tables have already been adjusted to account for the quarter-year convention. And lastly, when disposing of an asset under the quarter-year convention, a half month of depreciation is taken in the month the asset is disposed of. Again, this is going to ensure that the appropriate portion of depreciation is claimed in the final year based on the actual time the asset was in service. As you see, the IRS, they've thought of everything, right? They are on top of it. They are making sure we are following the rules in a fair and balanced approach. Now, here's kind of more of a recap. Nothing here too new except for probably 0.5 dealing with bonus depreciation in section 179. We'll deal with those later on. But if you wanted to recap, take a look through this slide. Not going to spend time reading it. It's a lot of what we've seen before, but just more practice, right? Repetition. The more you see these numbers, the more you see these concepts, the better off you'll be. Similarly, here we've got points on real property under MACRS. This is something, again, I would highly advise you take a look at. I'm going to go through the last paragraph here. The MACRS system employs a mid-month convention for real property, which assumes that the property is placed in service or disposed of in the middle of the month. Consequently, regardless of when the property is actually placed in service or disposed during the month, half a month of depreciation is taken for the month of placement or disposition. This means that the first and last year of the depreciation schedule is going to have 11.5 months of depreciation with full 12-month depreciation for the years in between. All right, more examples here. Let's assume you purchased a non-residential property for $1 million, including land valued at $200,000 and the building valued at $800,000. So that's the breakout there. And the important point there is we see that, well, of the $1 million, the full amount's not getting depreciated. We have to subtract out the land because land is not depreciable. So calculating the MACRS basis depreciation there, we are seeing that we are taking out that cost of the land. Then what is the amount of depreciable years? Well, we know that for that non-residential property, that's going to be 39 years because you have that memorized by now. For sure, you got that. Calculate the annual depreciation, divide the depreciable basis by the number of depreciable years. Here is our annual depreciation, $800,000 divided by that 39 years. Now we're going to apply the mid-month convention. Assuming the property is placed in service in June, the first year will have 11.5 months of depreciation, and the last year is also going to have 11.5 months of depreciation. Here we see the first year depreciation is 11.5 months divided by 12 months and multiplying that by the annual amount, giving us about $19,000. Now for years 2 to 38, well, that's a long period of time, couldn't imagine something like that. The annual depreciation would be that amount, that $20,512. In the last year, year 39, the depreciation will again be that $19,000 amount, accounting for the mid-month convention. Now, these depreciation amounts will be used to offset taxable income for the property owner, thus reducing their tax liability, sending everyone off happy because they have to pay less taxes. All right, let's see some examples of personal property versus real property. As we've seen why it's important to distinguish between the two, we are going to have multiple choice questions that ask you, hey, what's personal property versus real property? And then also building on that, getting into depreciation. First off, we've got tangible personal property. We've got machinery and equipment. These are industrial machines, office equipment, computers, printers, manufacturing tools. We've got vehicles, trucks, vans, cars used for business purposes. We've got furniture, office desks, chairs, filing cabinets, fixtures, lighting, shelving units, just getting a good familiarity with our classifications here. Then we've got real property. Well, this is kind of like real estate. That's what we call it that. The actual land on which businesses located, they operate. Buildings, so office buildings, warehouses, factories, anything like that. Any improvements to the land or any leasehold improvements. So that's a whole concept in accounting is leasehold improvements. What happens if you're leasing a building for 50 years and you make improvements to it? Well, those are assets in and of themselves. That's not a big topic for the exam here, but it's just a big topic in accounting overall. Now, distinctions between personal property and real property. Personal property is immovable and consists of tangible assets used in the operation of a business, while real property is immovable and consists of land, building, and other structures. Depreciation methods differ for personal and real property. As we saw, personal property is typically depreciated using the MACRS system, which includes either the half year or mid-quarter. However, real property is usually depreciated using the straight line method with a mid-month convention. We saw that on the prior slide. So yeah, we're really getting into it and kind of seeing the differences. It's important for you to memorize these, understand, again, the classifications of types of assets and the differences there. And the depreciable life differs between the two. Personal property generally has shorter recovery periods, while real property has longer recovery periods, as we saw, so there's 3, 5, 7, 10 years, as compared to 27.5 and 39. That's a big difference there. Make sure you take note of it. All right, more examples. Gotta love it. We are not leaving you here without some good practice. Let's assume that ABC Corp purchases equipment for $100,000 on April 1st, year 10. This equipment falls under the 5-year property class for MACRS depreciation. The company has not purchased any other equipment during the year. That's good to know. For the half-year convention, regardless of when the equipment is placed in service during the year, it's assumed to be placed in service in the middle of the year. Now, for a 5-year property, the MACRS depreciation rates are as follows. However, you would have to go and find that on the chart. So a good example would be pull it up in the resources where we've got the depreciation tables and see if you're able to find these percentages. Make sure you used the proper 5-year class and the proper exhibit. Under the half-year convention, the depreciation expenses for the equipment would be following. We got in year 10, take that full $100,000 times 20, then year 11, $100,000 times that 32, and so on and so on. Now, for mid-quarter convention, under the mid-quarter convention, when more than 40% of the total depreciable basis of property is placed in service during the last 3 months of the tax year, the mid-quarter conventions used. The depreciation rates are going to vary depending on the quarter in which the property is placed in service. Now, in our example, the equipment was purchased on April 1st, year 10, which is the second quarter. For a 5-year property under the mid-quarter convention, the depreciation rates for the second quarter are as follows. We've got them here. And again, similar process, $100,000 times 35%. $100,000 times 26%, and so on and so on. Now, note, in this example, we assumed that the half-year convention is applicable, one, since we didn't provide information about other purchases during the year. If more than 40% of the total depreciable basis of property were placed in service during the last 3 months of the tax year, the mid-quarter convention would apply. Lots of examples, making sure you're getting these down. Just, we change one thing, how does that affect the question? Change another thing, how does that affect the other question? Building on what we saw before on our previous example, we're adding to that a little bit more, see what happens. Assuming more than 40% of the total depreciable basis of property were placed in service during the last 3 months of the tax year, the mid-quarter convention will apply. Now let's consider that ABC Corp purchases additional equipment, but this time on November 1st, year 10, which also falls under the 5-year property class for MACRS. The cost of the new equipment is $200,000. Now here we see that the total depreciable basis of the property for the year is $300,000. That's $100,000 from the first equipment and $200,000 from the second equipment. Since the second equipment worth $200,000 was placed in service in the last quarter, that means more than 40%, do a nice simple little math there, more than 40% of the total depreciable basis of the property was placed in service during the last 3 months of the tax year. That's 66%, 2/3. So the mid-quarter convention will apply. For a 5-year property under the mid-quarter convention, the depreciation rates for the second quarter, which is the first equipment, and the fourth quarter, which is the second equipment, are as follows. This is what happens. In this example, we have equipment kind of took over, right? The second piece of equipment took over in the fourth quarter. It hijacked, so we have to use the mid-quarter convention. But we did have that original piece of equipment for $100,000 that was placed into service in the second quarter. So we saw that we had 4 different tables for the mid-quarter convention, and we're going to use the second quarter table for the first piece of property and the fourth quarter table for the last. A lot of these questions you're going to see just using the fourth quarter because there's just a piece of equipment that was put in the fourth quarter. But if you have a minority amount of property that was put into place in any of the first, second, or third quarters, then we would use those tables, charts, and that's when we would see those being used. So make sure you understand you're pulling them up properly as you go through exhibits on simulations. Now, using the mid-quarter convention, the depreciation expenses for the equipment would be the following. First, equipment purchased on April 1st, year 10, second quarter. This is our calculation here, just same as we've been doing, taking the percentages and applying them. And then the second equipment that was purchased on November 1st, year 10, that's the fourth quarter. We are doing that same process again, just taking those percentages and multiplying them. Now, in this example, due to the timing of the property placed in service and the fact that more than 40% of the total depreciable basis of the property were placed in service during the last 3 months of the year, the mid-quarter convention is used for both equipment. I think this is a great example, kind of bringing it all full circle. These are all the tricks that you'd see on the exam. Not much more they can do other than just throw additional pieces of equipment and make it more complicated with that. But I don't think they'd be that cruel, but prepare for anything. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.